Alright everyone, let's get started. Welcome to another episode of Crypto Corner with myself, OJ, crypto analyst and investor since 2016. I've started this YouTube channel back in 2016 to help you navigate safely in the crypto space, to grow the crypto community. At the time, it wasn't actually that many YouTube channels, and we continue to do that. We continue to spread the word about cryptocurrencies, to do market analysis, deep dives into different projects and everything. Today, I'm actually going to talk about stop loss orders and particularly trailing stop loss orders, because this is what actually helped me during this last dip. As you can see, the market is down today, and it actually dropped quite significantly over the last day, and I exited all of my positions purely on autopilot because I had set some trailing stop loss orders. And in one of the groups, people were asking me what is a trailing stop loss order, how to use it and everything. So I decided to dedicate this episode to trailing stop loss orders. I'm gonna explain them in more detail, give you a couple of examples, and hopefully this will help you get better in your trading and be more successful in your crypto investing. So without further ado, let's get started today's episode. Trailing stop loss orders, what are they, how to use them? Alright, well first, trailing stop loss orders. These are type of trade orders that are used in financial markets such as stocks and forex and of course cryptocurrencies. This type of order is used to help traders lock in profits and limit their potential losses. This is why it's called stop loss. A trailing stop order is an order that automatically adjusts the stop loss level as the price of the asset moves in the trader's favor. The stop loss level is the price at which the trader's position will be automatically closed out if the market moves against them. Meaning, you can place this order in both directions, either up or down. It can be a stop loss order to sell, a stop loss order to buy. The trailing stop order works by setting a trailing stop distance, which is the number of points or percentage distance from the current market price. Now, this might sound a little bit abstract, so let's go into the charts and take an example. By distance, what I mean is that if, let's say, you bought at $1,000, this is Ethereum back in the day, let's say, we are working with round numbers just to make it easier. Let's say you buy either at $1,000 and you set up a distance of 5%. That means that the stop loss is set up at 5% below your buy price. So with the standard stop loss order, what you would do is you buy at $1,000 and you set up your stop loss to be below that. So if the market goes down, you are protected from a further decline. And typically you would set up that stop loss at 5, 10%, 15, 20%, it's up to you. Let's say you set up at your stop loss at 900. So if the market drops to 900, your order will be activated and most likely executed. However, if this dip is just a temporary dip, you can get stopped out of this trade and then the market could recover and continue going upwards. And you don't really want that. Here is a better look at this chart. So this is the 4-hour chart. Let's say you bought at 1,000 and you set up a stop loss at 900. So if the market drops to 900, then you're out of this trade. And then the market could recover very quickly and continue going upwards. So you don't really want to do that. What you want is to actually buy it at 1,000 and then ride this wave up all the way until you print a decent high. And then as the market starts correcting, you want to be selling on the way down and before it actually drops to another low or to the price that you bought. So here, as you can see, it went to 1,200 and then it dropped to 1,000 again. So during this peak at 1,200, if you have a trailing stop loss order, that stop loss is going to be trailing the price, meaning it will be moving up. It will get adjusted as the price moves up. So once you get to 1,200, if you have a trailing stop at 5% or 10%, then this will be moving up with it. And it's important that the stop loss level is adjusted as the market price moves in your favor, but never in the opposite direction. And this allows for you to lock in profits as the market moves in your favor, while also limiting your potential losses. If it is a sell order, the stop loss price will move up as the token price goes up. Then, when the market takes a dip, the stop loss will not move down, so the order will actually get executed if the price of the token reaches that of the stop loss. So if you place the stop loss of, let's say, 8%, Then your sell order will get executed when the market drops by 8% from that 1200 price that I just quoted you. It's important to choose the right trailing stop loss for your trades though, because a stop loss that it's too tight, such as 3% or 5%, may result in the trade being stopped out before the price has a chance to actually move higher due to minor pullbacks that the market makes all the time. Like here, as you can see, you bought at 1,000, but then the price first dropped down to 900 and 850 or something like that. And only then it went to 1100 and later to 1200. So if your stop loss was here at something like 3 or 4%, then you're already stopped out of this trade before you've given it a chance to actually move higher. On the other hand, a trailing stop of 20% is excessive and may not be suitable based on recent trends, so you have to take into account the regular market moves. If the average pullback of a market you're trading is about 4 or 5%, with bigger ones being 8%, then you don't really want to place a stop loss less than that. Like 3 or 4% stop loss would mean that the typical market volatility can easily eat your stop loss quickly and you're out of the trade. Maybe even at a small loss. Well, still better than a big loss, but what I mean is that if you're trading longer term and chasing bigger market moves, a better option would be trailing stop loss of 10% or 12%, which provides enough room for the trades to move while getting the trader out quickly if the price drops by more than 10 or 12%. And the 12% is a larger move than a typical pullback, which could indicate a trend reversal instead of just a pullback. Ideally, this is what your goal is. You want to prevent losses from a trend reversal, not just a minor pullback. Unless you're trading short term, of course, small moves. In that case, a 3 or 4% stop loss can save you from a bigger move of say 5, 7, 10%. This would work fine for a short-term swing trade, but you will have to be proactive and make sure that you monitor the pair closely so that you can jump in soon after, before you miss out on a bigger move, like here for instance. So let's talk numbers. Let's say you bought Ether at $1,000 and set a trailing stop loss order with a trailing stop distance of 10%. This means that your stop loss level will be adjusted to 10% below the highest price that this token reaches after you buy it. Your stop loss being 10% is originally sitting at $900. If the price moves up to 1,100, your stop loss level will be adjusted to 990, which is 1,100 minus 10%. If the price continues to rise and reaches 1,200, your stop loss level will be adjusted to 1080, which is 1,200 minus 10%. If the price of the token drops to 1080 or below, your position will then be automatically closed out at the stop loss level of 1080, limiting your potential losses to just 10% and locking in a small profit of $80. On the other hand, if the price of the token continues to rise and reaches 1300, let's say, then your stop loss level will be adjusted to 1170, that's 1300 minus 10%, and if the price drops to 1170 or below, your position will be automatically closed out at the stop loss level of 1170, locking a profit of $170 per token. So, with a tighter stop loss, it will look like this. You bought it at 1,000 and set up the stop loss at 1,000 at 4%. Your stop loss level would originally set at $960, that's 1,000 minus 4%. And if the price drops to that 960 or below, your position will be automatically closed out at the stop loss level, limiting your potential losses to just 4%. But let's say if the price didn't drop and it just started going up from the time you bought it and it went to 1100, your stop loss has moved up as well and it's now sitting at 1056. That's 4% below 1100. Then the price falls back to 1050, your order is triggered by this drop and ideally you sell at 1056, locking in a small profit of $56 but avoiding a bigger loss. If the price doesn't fall but goes higher, reaches 1200, your stop loss will have adjusted upwards to 1152, that's 1200 minus 4%, and a subsequent drop to that price level will trigger your order and you can lock in a profit of around $150 depending on how fast your order can be executed. If it is indeed Ether, there's a lot of liquidity, high trading volume, so you're okay. Some altcoins though have very low liquidity, so you have to be careful with those. You want to be able to jump in and out of a trade quickly, especially with trailing stop loss orders, so only use them for markets that have high liquidity. And also, if the token price continued to rise, the trailing stop loss would have continued to trail the price, moving upwards as the token price continues to climb. This would allow you to continue to be in this trade, to stay in the trade and participate in any further upside potential, while also providing downside protection in case the token price were to suddenly reverse and decline. But if a 4% or 5% stop is the typical market volatility, then you can be out of this trade too soon if you set up a very tight stop loss difference. This is why you need to test out a few times before you can use this more confidently. Make sure that you research the market well so that you know what to expect. I mean, what are the most likely moves, the most likely scenario? I'm not saying that you have to know exactly what will happen. This is not possible, but we do use technical analysis to be able to tell what is likely to happen. Usually there are at least 2 or 3 different scenarios that are most likely to play out, and being able to read the charts and anticipate certain moves will be essential for making this work best for you. And here's a disclaimer: trailing stop loss orders can be a useful tool for traders who want to take advantage of market movements while limiting their potential losses. However, it is important to know that trailing stop loss orders do not guarantee profits or prevent losses in all market conditions, and traders should always have a risk management strategy in place. I'm saying this because you have to be aware of the different possibilities and you have to be able to take losses. You have to be able to exit a trade at a small loss and not really worry about it, because too many traders are only focused on making profits and they can't take a loss, especially in the beginning. Inexperienced traders are really bad with taking losses, so it's very important to know how to manage your risks and to have different risk strategies in place and risk management. And trailing stop loss orders are just one of the tools that we use, one of the ways to have a strategy, a risk management strategy in place. So make sure that you learn more about them and start using them. And also, I said they can be also placed on the way down. This is if you want to be buying. So let's say the token price is going down. Let's go again into the charts and let's use this one as well. So let's say you actually are looking into buying the token, but you're not yet in a trade and you're seeing that the price keeps going down. So you can actually set up a trailing stop loss order that is going to be trailing the price on the way down. And as it hits a bottom, let's say you set up a 5% or 10%, difference. So it hits the bottom and then it starts going up, it starts recovering. Then your order will be triggered when the price goes up by 4 or 5% or 10%, whatever your difference is. So if your difference is 5%, then the price will first hit a low. It would wait to start going upwards so that this is now marked as a low. And as it starts going upwards, when it goes more than 4%, that would trigger your order and you will be buying at 4% higher than the bottom here. So this is how you can actually catch a bottom. Not necessarily catch a bottom, of course. Nobody can catch a bottom perfectly. Every now and then it happens by chance. But a lot of the times we are actually waiting for a confirmation. We're waiting for the bottom to form, for the price to start recovering, to start going upwards. Usually more than 4% actually. I would say 7 or 10% is decent, because that would mark a trend reversal. You want to be buying into the market once the trend has reversed, so it's no longer going down, but it's actually going upwards. This is what you're looking for. Like here, the price went down and you want to be buying on the way up rather than on the way down. But of course, sometimes it happens that you buy and the price goes a little bit lower. Don't worry about that. The important part is a trend reversal. So if the price goes by 3 or 4% down, then it's not a trend reversal, it's just a pullback. But a 7, 8, 10% or 15% is definitely a trend reversal. So typically you want to be setting your stop loss order differences to be higher than 3 or 4%. But again, this is for bigger moves. If you're looking at position trading, even swing trading, sometimes you can be looking at this kind of percentage differences. But if you're doing shorter term trades, then of course 3 or 4% could be working very well for you. So it really depends on your trading style. One of our sponsors is Token Metrics. I chose them to be one of our partners specifically because I use this website a lot in my marketing analysis and research. If you want to know where is the right time to enter a position on any coin or token, and more importantly, when to exit, because this is really the difficult part. There are loads of metrics here to help you with that. This is one of their new tools that helps me analyze the market better and spot the right entry or exit points. As you can see, it gives you a green signal when the market turns bullish, meaning we are in an uptrend, and the red signals indicate when the market has turned bearish. Thus, exiting positions and preventing losses becomes really easy with this tool. There are so many tools that you can use. Here's another one, the out season Bitcoin season indicator, that gives me a very good idea if it's time to diversify into outs or should my focus be on Bitcoin instead. There is no need to be a back holder during a bear market. I think by now that much is clear. And with this tool, it's a no-brainer. They provide in-depth data and stats on all cryptocurrencies and a lot of new upcoming projects, launches and token sales too. This is where I find unknown gems before they hit the mainstream, and I particularly like their emails with detailed breakdown on technicals and fundamentals on the projects that they research, and their expertise in this field is second to none. You can also customize your portfolio and track your P&L day to day, and you can create separate portfolios for different exchanges that you use to monitor your progress in the most efficient way. There are so many categories to choose from when analyzing the markets, way more than I've seen on any data aggregator website, so you can really advance your analysis and improve your investment strategies. I've been a premium member of Token Metrics for the past 2 years, and I'm using it on a daily basis. They send us emails, host webinars and podcasts with technical analysis, and they go deeper into their research of new projects or current market conditions. I find this really helpful in my own market analysis, as they give me a hint to things that I might have missed or overlooked otherwise. They offer a trial period and you get a 10% discount and a free ebook with my link, so go check it out, it's in the description below. Alright guys, well this was everything for today's video. I wanted to make this very quickly just so that I answer your questions, because I saw a few people asking me in a couple of the groups that I'm in, because as I was posting yesterday that most of my trailing stops got hit and I'm out of the trades and I'm back in stable coins right now. People were asking me how to use this, so this is for you guys, and also for all of you out there on YouTube who are not in my groups or maybe who don't even know this channel. This is answering your question. Make sure that you leave a like and a comment below, and make sure that you're subscribed. If this is the first time you're coming across one of my videos, I post regularly, 3 times a week. I post about crypto markets, all kinds of things. Sometimes it's news or market analysis, specific technical analysis on different tokens like Bitcoin, Ethereum, XRP, all of the major tokens I cover, and especially new updates and releases that would actually affect the market price. And of course, all of these informative videos when I'm explaining different things about trading or investing that you need to know in order to trade safely and to navigate safely in this crypto space. Hit the notification bell so you never miss a video, and while you're here, just pick another one of my videos and I'm gonna see you there.